We do believe it is that big. So if you look at the revenue growth the last 5 years, it's compounded at roughly 48% per year. And that was, as you recall, when Tesla was experiencing quite a bit of controversy. Our forecast for the next 10 years is in the 50 to 60% range, depends if you take our bull or our bear case. And there are a few reasons. There are four barriers to entry that seem to have gotten higher in Tesla's favor. The first is battery technology. So Tesla is the only car manufacturer, with the exception of just a couple in China, the only car manufacturer that decided to ride down the cost curve of the consumer electronics industry using batteries that we find in our laptops, our cell phones. And when Tesla decided to do that, auto manufacturers actually laughed at it, as did auto analysts, because there were advertised or publicized battery blowups on airplanes. And so there was a banning of that kind of battery. So because of that, its costs are so much lower today. The cost of its battery or its battery pack system is so much lower than other auto manufacturers that if they really want to compete with Tesla, they're going to have to lose money in electric vehicles while their gas-powered vehicle sales are falling. That the alternative will be less power or less range. So we're seeing a lot of permutations around that. So battery, still 3 to 4 years ahead in terms of cost declines of other auto manufacturers who decided to use lithium-ion pouch technology as opposed to the cylindrical batteries that Tesla uses. The second barrier to entry, and this I think is the critical one from a valuation and a growth point of view. Tesla is the only auto manufacturer to have designed its own chip. Tesla is taking a leaf from Apple's book. If you remember in the day, Apple was the upstart. Nokia, Motorola, and Ericsson were the winners in the cell phone space. Apple was this upstart that had the point of view, Steve Jobs, that this was not just a phone, it was going to become a computer in our pockets. And he was right. And I'll never forget the delight I felt when I was able to access the internet on my phone. I just thought this was revolutionary.
Tesla hopes that the new investors go for the ride after the stock split. And unlike its cars, Tesla shares are about to get less expensive. Tesla is splitting its stock 3-for-1, so after the close of trading on Tuesday, investors will receive 2 additional Tesla shares for every one they owned as of August 17th. And in theory, that should drop Tesla share price by 2/3 before trading starts on Wednesday. The stock split, they don't make a company more valuable or profitable, but their appeal in terms of investing goes up. At least that's what I think. It becomes more appealable. It creates more appeal for the investors, and Tesla joined stock market heavyweights Amazon and Google parent Alphabet in splitting their high-priced shares this year. Even meme stock darling GameStop has done a stock split. So why do a stock split in the first place if it does not change a company's value or profitability? Stock splits are used by companies when the stock's price gets too high for retail investors to buy individual shares, or when a company wants more shares in the marketplace to make them easier to trade. Employees who hold a company's stock can benefit as well if new investors push the price higher. And the lower prices also should make the shares easier to sell. And Tesla shares traded for more than $1,000 when the company announced its intentions to split the stock in March. And that's a bit steep for most retail investors. $1,000 a stock, and some brokerages let investors buy a fraction of a share, but not all. So there are a lot of people who want to buy Tesla stock, but just because it was priced at $1,000, not everyone can afford it. So after the stock split, the people who thought they could not afford Tesla stock can now actually buy Tesla stock. It doesn't change change anything, they're getting the same thing, just a smaller fraction. And companies that split their stock tend to outperform the broader market in 3, 6, and 12-month periods.
The others didn't follow. They didn't have their own chip. They didn't have the vision. And today, even today, when Apple's market share has gone down to 12%, it takes most of the profits out of the global smartphone market. And then the other two barriers to entry. So the artificial intelligence chip, why is that important? This is all about autonomous travel. And it's the only one doing this. And we believe that the other barrier to entry they have is the billions upon billions upon billions of miles of real world driving data that Tesla has accumulated, so that with its AI expertise, Andrej Karpathy is the expert in autonomous transportation. They now have more corner cases to train their systems on than any other company. It's not going to be possible for these companies to catch up, because Tesla already has more than a million robots, including my Model 3, roaming around, collecting data and sending it back every day. And then the other barrier to entry, which I'm surprised this one still exists, is over-the-air software updates. I got my Model 3 in 2018, and I've never had to take it in for a problem. Tesla apparently has diagnosed any problems I've had and corrected them before I see them or experience them. The only problem I've had is a nail in a tire. And of course, software could not correct that. But that was it. And so those 4 barriers to entry have given Tesla the lead. Our base case is $3,000 in 5 years from $800 today. And our confidence in that has grown, because what we're seeing now is Tesla able to scale EV manufacturing in a way that no one else, except perhaps BYD in China, no one else is doing this yet. And Tesla had to go through a huge learning curve to get there. This is not like